Oh, there's a lot of people that don't even know this exists. I mean, people thought this kind of stuff was done away with when they restructured all the lending that's out there. So they're going to love this discussion today. And if you just joined us, we are talking about the best kept secret in real estate financing. And so we're going to start off here with a pop quiz. Now we'll get some help. So if you don't know it, don't sweat that. But right now, see if you can name two programs that still allow 100% financing for home buyers. So help us out with the first one here.
Well, the first one is the VA loan program. That may be one that folks are aware of. It's a great program. It's an awesome program for folks to buy and refinance homes. The only trick is you have to be a veteran. So if you haven't served in the armed services or eligible in some other way,
right,
then you can't use that program.
Okay, now, by the way, that has to be you. Just this isn't really about VA loans here, but for a VA, that has to be you, not a family member, right?
Correct. If you're not a veteran, however, there is another program that we're going to talk about today that is the USDA Guaranteed Loan Program, which is, frankly, a more broadly used and applicable program because there are more folks that would qualify for this than would qualify for VA. And the great part of this is not about inspecting meat or whatever on the USDA. That is the Department of Agriculture. The Department of Agriculture issues loan guarantees for people to encourage them to purchase homes in what are considered rural areas. So it's a great government incentive program that's out there that folks just don't know about. And the only limitations are you can't make too much money.
Yeah.
If you make too much money, they say, well, then you can go get your financing somewhere else. And it has to be in something that's considered rural, which is not as much country as most people think. So we'll get into that.
So again, right now we're talking about the USDA, not what's in the meat section of the supermarket, but the Rural Housing Program. And really, this is the secret weapon for 100% financing so families can get a home of their own with, I mean, we're talking all caps here, no money out of pocket. You can actually come to a closing with no money out of pocket.
That's right, and a lot of folks don't believe that. They think that's gone away, that it's not possible, and I'm here to tell you today it's just not true. You can absolutely get 100% financing, no money down, no closing costs, no prepaid items, no cash at all from the buyer of a home using this Guaranteed Rural Housing Loan Program.
Okay, well then let's break it down here. So what we need to define here quickly is what it is. We'll talk about some of those parameters, and you sort of alluded to those a moment ago, so we're going to give some details on that, and then we're going to talk about who can use it. So first of all, tell everybody here what the program is.
Well, it's really very simple. It's a government guaranteed loan program for purchasing and refinancing of homes in rural areas. Now, a little footnote here, refinancing under this program is only available to those folks that already have a USDA loan, and you know who you are. So if you've already got one, you may want to use this to refinance because it's a great program for that too. But for most people, they wouldn't be able to refinance this if they don't already have one of these
So
loans.
I couldn't bring my conventional loan in here and refinance it with this program.
Correct. You couldn't bring a conventional, any other government loan program, FHA or VA, you can't bring any other loan program to refinance to the table here other than an existing USDA loan. That's right.
All right, and let's talk for a minute. Kind of before the call, you were sharing with me the definition of rural. I think you said that it's anyone who's located probably, what was the deal with the 15 miles from like an urban center?
First off, it's really easy to determine if our property address is eligible. There's a website that you can go to. We'll talk about that in a minute. You basically Google rural housing loan availability or eligibility, and their website will pop up. Rather than give you a 57-character web address, just go Google it, and you'll find out whether or not the address qualifies. So basically, there's places all over the country that qualify, except in the most densely populated areas. And so you typically kind of draw a circle of 10 or 15 miles out from an urban center. You know, for example, I'm in the Midwest, so you pick Indianapolis or Cincinnati or Columbus or Louisville or something like that.
Yeah.
And you just kind of draw a circle around, say, if you got 10, 15, 20 miles from the middle of those cities, you're in what's considered rural areas. And that's true across all the country, except in the very, very dense areas. I mean, there's, in Florida, you don't have to be too far outside of Tampa and St. Pete, for example, to be able to qualify there as well.
Well, so, I mean, based on that definition, it sounds like, you know, 90 plus, even maybe 95% of the geographic area of the country would qualify this loan. So, I mean, unless you're that close to an urban center, there's probably a good chance you could qualify. Now, we're not telling you right now here that you would. You need to go check it out, but there's a good chance that you may, right?
Right, absolutely.
Okay, so the next point here, true 100% financing. Tell us exactly what that means other than what's obvious here.
Well, what it means is that this program was designed and created for folks that didn't have enough money to make a down payment on their home, up to 20% down payment. So what it allows for is the purchase price of the home plus closing costs and prepaid items to be financed. And you have to structure the contract properly to make that work, but it basically doesn't require any cash from the buyer. Now, in these times, buyers typically have to advance the cost of an appraisal because sometimes deals go south and nobody wants to be hanging out there for an appraisal. And so typically the buyer has to advance that cost, but they get it reimbursed at closing. So really there's no cash at all. When all is said and done, the dust settles and somebody's moved in, homeowners insurance, closing costs, appraisals, title fees, everything can end up being financed, so the buyer has to have no cash. But the next point that here that's really important is that it's a true 30-year fixed loan.
Yes.
There's no ifs, ands, or buts. I mean, they have adjustable rate programs. I don't know why anybody would want to do that. So the rates are so doggone low, but there's no mortgage insurance or no PMI. Now, FHA loans, for example, have a mortgage insurance fee that gets paid every month. Well, VA does not, but here the USDA loan program doesn't either, so it's right up there as one of the absolute best loan program out there.
Yeah, see, that's a big expense that a lot of people, I mean, it's just sort of a necessary evil. I want the mortgage, but, you know, with this high percentage being financed, I know that I'm going to get stuck paying mortgage insurance, although I can come back later and get it removed. Most people never do that. In this case, it's not there at all.
Right, so it's never something you have to worry about. The rate you get is the rate you get with no hidden fees or gotchas, no extra payments.
All right, so now the last point, speak to us about that one.
Well, there is no free lunch. I mean, there is a fee that has to get paid for this wonderful benefit, but it's very reasonable. See, what happens here in the Guaranteed Loan Program is lenders, large money center banks across the country, and you know their names. I won't put them here for free advertising, but the largest banks in the country actually make these loans. They then get guaranteed by the federal government, by the Department of Agriculture. So in the event that somebody, who knows, dies, loses a job, they end up defaulting on the mortgage. And that does happen to good things. Bad things happen to good people.
Right.
Let's pretend that were to happen. Well, what happens then is that the government will keep the lender whole. They will reimburse the lender for a lot of their losses in the event that it goes to some sort of auction or foreclosure. Well, for that to work so that these funds are available to pay the lenders in the event of these defaults, the USDA collects a fee up front, a one-time fee of 3.5% of the loan amount. That's very similar to the VA funding fee. In fact, it's identical as to what it does and why it's there.
Yes.
And what we call the upfront mortgage insurance for any FHA loan. So all these government-backed programs have a guarantee fee. And in this case for USDA, it currently stands at 3.5% of the loan amount. It's a one-time fee. And the cool thing is it can be added on top of the purchase price and the loan amount.
So again, that's financed in, and you're still looking at a loan with no cash required from the buyer.
Yep, so you move into your brand new home, and whatever money you have, you can use for decorating or furnishings or whatever you want to put anything into the purchase process. It's a wonderful, wonderful program.
Wow, very strong. That's quite a program now that we understand what it is. Listen, if you think you might qualify for this or you want some more information about it, just give us a call. Our number is right down at the bottom of the screen, and you know, talk is cheap. It doesn't cost anything just to find out and get more information. So go ahead, give us a call, and we'll help you understand if this is something that can work for you. Okay, so having understood what it is, now let's talk a little bit about who can use it.
The key thing here is that it's really pretty straightforward, and it's very surprising. This is the area, kind of who qualifies to use this program, that's also misunderstood. You know, we were talking before about what it is, and the fact that the house has to be in a rural area and how rural might be surprising to people. Well, the same thing is true about who can qualify to use the program.
Yeah.
So any home buyer can use this program. It's not limited to first-time home buyers.
Yeah, I misunderstood it myself.
Well, and that's a common misconception. People think, oh, that's a first-time buyer program. Well, today there really aren't too many first-time home buyer programs out there. They don't really, I mean, there's nothing that's limited to them that I know of that's broadly available. There may be the occasional sort of weird thing in a local community that has local bond money in it for first-time home buyers, but sort of broadly available programs, I don't know of anything out there that's limited to first-time home buyers, and USDA falls in that same category. there is another restriction that doesn't come up very often, but if you're able to fund 20% down payment out of available cash or savings accounts,
Yes.
then you wouldn't qualify. You'd be kicked out of the program. And that makes sense because this program is designed to help folks of moderate means buy a home in an area to help encourage sort of population in the rural areas.
Just a clarification then, it's not discretionary. In other words, if you have those funds available in any accounts, you are disqualified from the program. It's not that you have them but want to use them for something else, and so you can get this program for people who don't have the money. If you have the money, you are disqualified.
That's correct.
Okay, good to know.
But there's a footnote there because this also, again, this can be confusing for folks if they are not fully informed. If you have money in a college savings account, a 529 plan of some sort, or in a retirement account of some sort,
Yes.
then that is not counted against you. So let's pretend you've got some nice money in a 401k or an IRA or something. They don't consider those as disqualifying funds. So it has to be in a liquid, non-tax deferred account to be available to disqualify you, if you will. Basically, you can be any home buyer. You can't have available up to 20% down. You can't have that kind of money. And you can't make too much money.
So how much is
we'll
too
talk
much?
about that in a minute. How much, if in the family of up to 4 people, they're making $74,000 a year combined,
Yeah.
then they qualify. So that could be a family of 1. This is a nice change in the program in the last couple of years. It used to be that every time they added a family member, they'd bump up the income limits, but they'd start pretty low for a family of 1, like a single person. They relaxed that in the last couple of years, where now 1 to 4 in the family gets the same income limit. So now there's some folks, with nice jobs, maybe single or just a couple with no kids or something. They now get the same income boundary that the families of 4 have, which is really nice because $74,000 will cover a lot of people.
That's right.
Family income.
There's going to be a lot of a large portion of the population that falls into that makes less than $74,000 as a family, particularly if you're counting
Right.
one person.
Exactly. Now, you can't exclude income from the family when you look at this thing. So if you're thinking, well, one spouse makes 60 and one makes 50 or something, sorry, you don't qualify, because even though you may not both be on the loan, they have to look at the whole household income. So
Yes.
just be aware of that. You might trip over that. But again, the point is, if it's a moderate income for a family in a moderate area, this program's for you. If you're knocking down big money and you got cash, it's not for you. So, but I think we speak to many, many, many people when we speak about this program. Credit. Credit's always a question here. Okay, how good does your credit have to be? And in the last several years, credit standards have tightened, over and over and over again, like a choking collar on a disobedient dog. It's been tightening up so much that a lot of folks that used to qualify for financing don't anymore. Well, the good news here is 620, which is I'll say a pretty modest credit score.
Yes.
620 and above, you're good to go. So that's
actually pretty liberal. Yeah.
That's very liberal. That captures a huge portion of the population. Well, they also then want to make sure that the home's going to be affordable for folks, right? Because the idea here is to put people into homes that don't have a lot of money but have a moderate income and are looking to set up a homestead and be there for a time. They want to make sure they're not going to stretch themselves too far. So they basically apply what debt ratios or expense limits, if you will, that are kind of standard for the industry of 29% of your income going to housing and no more than 41% going to housing plus other debt. Now, that's kind of a technical term. Don't want to get into that for a lot of the people that may be on this call, but it basically says, there's no super tight ratios and there's no real liberal ones, so it's pretty average.
Okay. Yeah, the 29 and 41, those are the standard FHA guidelines, aren't they? Or close to it?
They're standard FHA, VA, they're standard kind of across the board on all the loan programs that are out there today. So those are, you'd find those pretty much everywhere.
All right, and again, just in layman's terms, that means you can't have a huge amount of debt or that could disqualify you.
Right. Now you could have, for example, a very modest housing cost. Say you buy a modest home and the home is only 16 or 17% of your total income.
Yes.
So that means you could have a fair amount of other debt so long as you don't cross over that 41 number.
Okay.
This is the one that's most surprising to people is the next one. You don't have to live in Mayberry. You'd be surprised what qualifies. It's stunning. We're just within 10 or 15 miles of an urban center. Oftentimes you're in an area that qualifies. And there is a website you can go to check that out. So again, a huge portion of the country qualifies for this stuff.
Now, are you going to give us that website again later, or do you want to hit it again right now?
Well, yeah, basically, you just Google. We'll hit it now. We'll hit it again because it's easy to remember. If you go to Google and you plug in rural housing loan eligibility, it'll bring up a website where you can check that stuff.
Rural housing loan eligibility. You're just going to Google that.
You know, I just Googled it, and it's the third one from the top.
Okay. And now, how do they know which one it is when they're looking at the Google result?
They'll know it's a USDA site. It's
okay.
a USDA.gov site. They'll find it. It's really easy.
Okay, cool.
If it doesn't say USDA.gov, then it's an advertisement. So.
Okay, well that's telling. So when you're looking at your Google results, make sure that it's USDA.gov / whatever the results. There could be some other stuff after that. In fact, there will be. Okay. So the last point here, manufactured housing.
Yes, manufactured housing is available to be financed under this program, but only if it's brand new, never been lived in. So it's very, very rare anymore, but it is a niche that this program allows, and it's going to be more common in rural areas, obviously, than elsewhere. Just as a footnote, it is available. Housing just has to meet FHA standards, and if you are looking at a property like that, make sure you get the property checked out first to make sure that it'll meet FHA standards before you even consider trying to finance it. Because if it doesn't meet FHA standards, you are going to be disappointed.
And by the way, if you have any questions about which program it is or you'd like some clarification, you give us a call. Our number's right here at the bottom of the screen. We can help you understand which program it is that you've heard about, and also help you understand if you qualify for this program and on what basis you could be used, whether your home qualifies, what your income qualifications are, so on and so forth. Okay? So numbers right at the bottom of the screen. Give us a jingle. Doesn't cost anything to talk. Okay, so let's talk here a little bit more about the program, the guaranteed program.
Right, and this is just, I want to pound this home because misconception is the greatest barrier to people moving forward on something. They have doubts and concerns, and a lot of cases our doubts and our worries are ill-founded. And in this particular case, the rural housing program, the guaranteed program, is not that direct loan program that you may have heard about. A lot of real estate agents may be familiar, especially out in rural areas, may be familiar with the USDA program, but they're thinking the direct program where the loans are made directly by the USDA that have these really long turn times. It can take 3 or 4 months to get through it because it's all kinds of qualifications that you have to go through and proof that you don't have the means, et cetera, et cetera. And they're very modest properties. I mean, you're talking $30,000, $40,000, $50,000 homes that are challenging to purchase and finance. The guaranteed program is entirely different. So we put this extra message in here just to repeat that this is a different program. Now, little known fact, this is where you can surprise your friends and neighbors with this, is no prepayment penalties. Now, what's a prepayment penalty? If the home is sold or refinanced before the loan matures, 30 years from now or 15 years from now,
yeah,
some loans in the first 3 to 5 years might have a penalty that you would pay to pay it off. Well, not this loan program at all. The direct loan program, by the way, we talked about a moment ago, that's a little known fact. If you get into one of those programs, you have to pay back the interest subsidy that you've gotten over the years. So
wow,
you don't plan to move out of those anytime soon. Yeah, it could be a real, people don't know that.
Yeah, so you definitely, there's a whole bunch of differences here, obviously, but you want to make sure that you wouldn't accidentally, although I can't imagine based on what you're saying, that you would accidentally wind up in the wrong program. But that's huge. So you could get it this year and pay it off next year if you won the lottery or you got inheritance or you somehow came across other means.
And it's assumable. Okay, now what that means is there's really only 2 or 3 loan programs that I'm aware of that are assumable anymore.
I didn't know there were any.
Well, the FHA is assumable.
Okay.
And the USDA is assumable, and under conditions, VA loans are assumable.
I would guess that to assume this, a person would need to be able to qualify under the normal guidelines for the program.
They would need to income and credit qualify. They have to have sufficient income to meet the debt obligations, and they have to have sufficient credit. They could, however, take over a rural housing loan even if they made too much money to qualify for one as a purchase.
Oh. Somebody
who's selling a home that's got financing from the USDA on it, you may very well be able to assume that note.
Okay, well now, a moment ago you said that you'd have to meet the income and the credit qualifications, but assuming a loan, you could make enough money that would disqualify you if you're trying to buy it, yet you could assume it. So how does the income qualification work on the assumption?
Well, basically, you have to make sufficient income to meet the debt obligations. Your debt ratios have to be within limits.
Okay, so you have a low end limit, but frankly not an upper end limit.
Right.
Wow. Well, that's quite a little secret to know, isn't it?
Yeah. It's a rare thing that's out there. It doesn't happen a lot, but it's definitely assumable. But why do you care about this if you're buying a home under this program? Well, when you're buying a home today with interest rates at record lows, and you now have financing for that home, and you probably have 100% financing for the home that's available, that's locked in at a rate for another 25 or 30 years, that's at historic lows, that is a great marketing leverage point to be able to help sell your home. Hey, I can offer you 4.5%, 5.5% financing when rates may be 6 or 7 or 8.
Yes.
So that could really make the home much more marketable.
Absolutely.
Now they could easily change that. You know, that's the sort of thing with the stroke of a pen. Congress could say they're going to stop making them assumable. So I wouldn't bank on that, but it's a nice little benefit that you don't pay anything more for.
Yes.
It's not just for first-time buyers. That's a very key thing to remember, that it's not restricted just to first-time buyers.
So it really doesn't matter how many times you've owned a home, whether it's in the last 3 years or whatever. If you have the income and the location qualifications here, you can qualify for this loan.
Yes, and in fact, you could even go from one to another, presuming that you got moved around a bunch. I mean, not that you necessarily want to, but so long as you can continue to qualify and you're buying in other areas, you can use this program over and over again with no changes in fees.
Okay, cool, very cool. Okay, the cash you talked about before, but let's just hit that again, because what you said before was you can have too much cash. If you have more than 20%, you're disqualified, but apparently, I mean, can you have 19%?
Yeah, theoretically you could. I think the point is if you've got 5 or 10 or 15%, you don't get disqualified.
Okay.
It boils down to kind of a judgment call from the USDA and from the underwriters to say, well, if it looks like you're pretty close to being able to finance one on your own, then they may say, we don't think so. We think we'd like to save the benefit for some other citizens.
Yes.
But frankly, folks that have 20% down are probably not looking in this sort of a price range. So,
right.
But you never know. I don't mean to disqualify anyone. You don't have to be destitute to use this program. So you don't have to qualify for food stamps. You can make good money and have some money and use this program.
Very cool. All right, let's hit this next one. And we don't have to spend a lot of time, but a lot of folks aren't going to know what a 2-1 buy down is.
There are options to get a lower interest rate for the first couple of years. Pretend that you're buying your first home and maybe you've just started a job and you're growing in income. You're a little bit nervous about stepping up from a $300 a month rent payment or living in the basement of your parents' home or something, and you say, boy, it'd be nice if I didn't sort of jump into my $1,000 a month payment all at once. Maybe if I could go 800, then 900, then 1,000 over the next couple, 3 years, that would make a smoother adjustment. Well, there are loan programs out there through VA and FHA and through the USDA as well that allow you to have a programmed step up in payment like that allows you to get into a lower cost payment in the first couple of years. It's a so-called buy down, where basically the seller can pay a fee for you up front to enable you to have a lower payment in your first couple of years so you can kind of grow into the mortgage.
And you just sort of hit something really important. You say, well, why would the seller be willing to pay the fee? Well, because frankly, it's a pretty small fee to do that, and the seller still gets almost his full asking price. In fact, you can use that as leverage that, the seller's probably sitting there thinking somebody's going to come and try to beat him up on his price, and so you can come in with nearly a full price. If you say, look, take that full price and pay this fee for me, and you got a sale, so he's got a very high percentage of his asking price, and you've got much lower payments for the first 2 years of your loan.
Exactly correct. But that's just another advantage that this program has that says that you can actually use it.
These other points you already hit on, but just review them again for us real quick.
Well, the 3.5% funding fee may be a little bit frightening to some folks if they're not familiar with how the other government loan programs work, but this is very consistent and in line with the other programs. The costs are going to be very similar to VA and FHA, but there's no monthly mortgage insurance, which FHA has. VA doesn't have it, but you've got to be a veteran. This is kind of like a VA benefit for everybody that wants to live in a rural area that never served in the military.
Not only that, consider it this way. Most people have a mortgage for 7 years or less. So if you take that, don't think of it that you're going to have to pay a 3% funding fee out of your pocket, because you can finance that in and they'll actually put it on top of the loan. So you're really spreading that 3.5% out across 30 years.
Yes, absolutely correct.
So it becomes very nominal.
Yes.
Okay, so we talked before about eligibility, and we just want to hit it again so that you fully understand what you need to do. If you want to check for your eligibility, you just go to the website, okay? And you can Google this. You just put in USDA Rural Housing Loan Eligibility.
Right.
Right, the result that you're going to look for is going to have USDA.gov in the first part of the link.
Correct.
Okay.
And what's nice, when you bring that site up, there's going to be two areas. There's an address availability or eligibility component and an income eligibility. Now, most people will know whether they qualify on income sort of off the bat. So we'll talk about that in a second. But the location eligibility, you can either bring up a map. If you're looking for an area that qualifies, you can bring up a map of the county that you're looking at, and it's color-coded to show what qualifies and what doesn't. It's real simple to use. Or if you actually know the address of the house that you want to make yours, just plug that in, and it'll tell you right away whether or not it qualifies.
Wow, sounds really easy.
Even I can do it.
Wow, hey, beautiful. So location eligibility, you mentioned income, right? Somebody's going to know. You know how much you make, right? If you take your income and your spouse's income, and if there's other family members there, you add them all together, and if it comes to more than $74,050, you make too much.
Well, but there are, however, a couple of deductions in there that you can take for child care expenses or elder care expenses, those sorts of things. If you have dependents in the household that create expenses, then you might make $78,000 or $79,000, and you deduct some off the top to get you back down under the threshold. So just plug in your data. If you're close to the limit, run their eligibility calculation from that same website, and you'll know whether or not you qualify. It's very, very intuitive, very easy to use.
Well, like you said there, I mean, that is a huge point, and really, I guarantee 99% of people don't know about that.
Yep. I
mean, that is truly an insider secret that you've shared with us here. Okay, so some extra points to know, right? This is some more. These are some caveats. And armed with these things, you literally will know more than 99% of people out there about this loan program. So talk a little about these.
Well, yeah, there used to be that there was, a few years back, USDA required a separate home inspection done on the home in addition to the appraisal, which was a little time-consuming and a little bit more expensive, added cost to it. Well, they've conformed now, where they basically say so long as an FHA appraiser does the appraisal and certifies the home as meeting FHA standards, there's no additional inspection required, which is nice. It saves
a standard FHA appraisal.
Yes. Well, actually, not even an FHA appraisal, just an FHA appraiser doing the work. So
wow.
Yeah, it doesn't. Sometimes an FHA appraisal is a little bit more paperwork and costs a little bit more, but so long as the appraiser doing the work is FHA certified, and they put basically a line of text in the appraisal that says the
no
house
kidding.
is FHA required. Yeah, it's very simple.
Wow.
It kind of connects to the next point, and the reason why this is a little bit of this is definitely this is an advanced strategy. You can order the appraisal directly. The lender can do that, as opposed to having to go through a third party. Now, this is the HVCC nomenclature we have there stands for Home Valuation Code of Conduct.
Okay.
Which is like the Darth Vader of the home lending industry the last few years, where we've been required to order appraisals through third parties that may not be that familiar with the market area. So think of it as like a clearinghouse for mortgage for appraisals, and you don't get to pick the appraiser who may be familiar with the area. And there have been some crazy results that come out of this where an appraisal gets ordered through a company that's 100 miles away from the house because they offered a $25 discount or something.
Yeah, and they don't know the area really, so they're just taking pure stats, and you wind up with stuff that can be really inaccurate.
And very frustrating and time-consuming. So here's the good news. You got a list of FHA appraisers in your area that you're comfortable with, that you trust, that they're reputable, honest people that do good work. We can order the appraisal directly from them and don't have to go through the third party on this program.
Okay, cool.
So you know what you're getting up front with that person. They know the market, everything else. As we said, it's also the only program out there for 100% financing of new manufactured homes.
Okay, hold on a second. I mean, let that one sink in, right? If you want to finance a new manufactured home 100%, there is no other alternative. This is the only program that does it. I mean, that's huge. That's strong.
Well, I would hope the manufactured home producers and sales representatives would be all over this like white on rice, because it is their only way to help families acquire those products at a reasonable cost. Now, sometimes some of the dealers will finance these things, but then you're paying automobile and rates of 10-12%. Here's a case where you get 5% financing in today's market, 5.5% financing for 30 years fixed. And so, if you're looking at that and you're in the market for a manufactured home or a factory-built home. By the way, this is only for the caveat here is only for what we call double-wide manufactured homes. It does not include what we call modular homes that basically get counted like traditional stick-built homes. So this is only for the double-wide manufactured homes.
Oh, okay. Well, that's good to know. So this is not modular homes, and it's not single-wide. It has to be double-wide.
Yes.
Okay. And coming into this last point here, we said it before, but we just want to really drive the point home here. Seller can pay all of your closing costs and prepaid items. You really can come to closing with a net zero money out of pocket.
That's right. And it's the only program out there other than VA where that can happen.
Wow. Incredible. All right. So, and lastly, the last thing on here, if you want specifics, just give us a call. Our number's right down at the bottom of the screen. And you can find out if you qualify. It will help you figure it out, whether it's income-wise or location-wise or anything like this. We can take you by the hand and lead you through it and let you know if this program is free. You may be very surprised. So the number's at the bottom of the screen. Give us a call, and we look forward to talking to you soon.